Hi everyone, it's Thursday after the second RBA cut, and I thought I'd just leave it a couple of days just to let the dust settle and to think about the context. So yes, the cash rate's now 1%. The market was expecting it. The story is all about unemployment, and RBA is focusing on that trigger to stimulate the economy, and they'll keep going with rates until they're comfortable that unemployment is closer to the target rate, which is around 4.5%. Everyone realises that you can't rely on rate cuts alone, so they're also dependent on the government investing in infrastructure and kickstarting construction, albeit Frydenberg is probably very keen to declare a budget surplus because it's a great headline, but it's not necessarily great for an economy which is faltering. And the RBA is also relying on the tax cuts being legislated, which looks like it's going to come through, well, certainly the first tranche anyway. So all of that put together, they're hoping that they can kickstart the economy. There are obviously some global headwinds. The big one is the China-Trump spat, which they reckon, if this continues, could impair global GDP by 0.3%. And that's quite a big slug, actually. So there's a bunch of stuff happening there. So great for borrowers, dreadful for savers, and self-funded retirees. So there's always two sides of every story. In terms of what's happened with the lenders over the last couple of days, so again, you're going to see headlines about Bank X, passing on the full rate, hurrah, and Bank Y only giving 0.2, boo. Look, if you look at the rate cuts over both last month and this month, I think what you're going to see is that they equalise. I think those banks who passed on in full last month will only pass on maybe 0.17, 0.18 this month, and I expect that over the market, generally, banks will have passed on average 0.2 each time. Okay, so don't be distracted by a headline at the moment. We've got to look at it in the whole. We've also interestingly seen with two or three lenders, I think specifically Bank of Melbourne and Commonwealth, that they've reduced the investment interest rates slightly more. And that's partly because APRA have obviously released the brake on the investment lending, but also those particular lenders were a little bit out of the market when it came to investment rates. So a little bit happening there. In terms of house prices, there's no doubt that we've now seen the bottom of the market, and that was obviously kick-started by the coalition win in the election. It's just going to take some time for the stock levels to rise, because it takes time for vendors to make up their mind that yes, they will put the property on the market, then choose the agent, then there's a selling campaign. So we're probably not going to see decent stock levels for another couple of months, but in the meantime, buyer activity is very strong, and we've seen it in our office. In terms of serviceability and a capacity to borrow more, yes, the rates have been reduced, but we've not seen the cuts come through yet on the assessment rate that the banks use in determining borrowing capacity. So at the moment, there's no change in borrowing capacity. What you could borrow 2 weeks ago is still the same amount now, but it's a watch this space. We're expecting something to come through shortly. Other than that, well, actually, that's quite a lot. There's a lot going on right now, and we're coming into a very busy part of the year. As always, just give me a call if you want to have a chat about your own circumstances or just chew the fat. Generally, always here. And I hope you have a great rest of the month.